Selling Invitae stock is the title of today's presentation, and if you're somebody who's invested in Invitae stock or you're thinking about investing in Invitae stock, then this is a presentation that you're going to want to watch. So Warren Buffett once famously said that when the tide goes out, everyone gets to see who's swimming naked. So when we have the bear market now going into its second year, companies that don't have the best quality businesses are starting to rear their ugly heads. For example, firms that pay $1.50 for $1 in revenue growth. That's not sustainable. You see that a lot in emerging markets or even in developed markets where companies are trying to get ahead of their competitors in a space where there's no barriers to entry and they're trying to capture market share as quickly as possible. Subsidizing negative gross margins, we see that a fair amount. We don't invest in companies or even take them seriously until they have positive gross margins. Not making hay while the sun shines. So raising capital over the past decade prior to this bear market was quite easy, and people were just throwing money at practically anything. So if you didn't manage to raise a bunch of capital during that time and sock it away for a rainy day, then you're probably going to be hurting and scrambling to avoid bankruptcy now that capital has dried up. So the last time we took a look at Invitae stock was in May of last year. And in that article, I'll put a link to it in the description of this video. And there was also a video that accompanied this as well. In that article, we had put this table that you see here of revenue growth, and you can see there where it says 2022 guidance $640 million. And we had said at that time, provided Invitae hits their 2022 guidance, all should be well. So we were expecting that 40% revenue growth. And some of the comments we made on the right-hand side here, we said, would we add to this stock if we didn't already max out on it? So when we invest in any particular stock, we have a maximum amount of capital allocated to that position. We'll dollar cost average in over time. Once we've exhausted that, we stop. That keeps us from trying to catch falling knives, which is what would have happened here. And then you overcommit into a particular position. And of course, you don't know where the bottom is, and you end up blowing through a whole lot of cash. And we said here, we would have added at that time to our position if we had more capital because our thesis hadn't changed. You see the revenue growth there. This is a leader in genetics testing. And we said, that said, we need to look at their latest restructuring plan to see what that entails. Well, we know what some of that looks like. And at that time, we had said, if you think Invitae is trading at bargain basement prices now, just wait until something really bad happens. Well, something did bad happen. They missed that estimate of 40% growth. So it was $3.40 a share back then. If you would have thought that was a bargain, well, you're sitting on shares that are worth $1.68 now. We said that if our thesis changes or growth stalls or any other company-specific event happens, there won't be much value left in our position to sell. Indeed, today we're down 93% on that position. We'll talk a little bit more about that. But when we look at the problem that took place that led to that share price drop, a key component of that was that they lost their growth. So instead of that $640 million they were guiding to in 2022 that represented 40% growth, the actuals were around $516 million, about 12% growth. Even worse, next year, let's say that's actually this year, 2023, they're guiding to $500 million. So for this year, they're expected to actually have revenues decline by about 3%. Now, this chart here that they put in their recent presentation is rather annoying. Here they try to paint this picture of their revenues increasing, and it's very easy to miss this. As a matter of fact, I did this presentation, the accompanying article, because I cover Invitae, and when I first looked at this, I said, well, low double-digit growth, that's acceptable. But then I did the numbers. You can see here on the right what they actually look like. Well, it's declining. And the picture they're trying to paint there on the left is just rather cheeky. It says that, well, of the revenues that we didn't divest, so the idea here is they're reorganizing and focusing on revenues that are profitable or could be more profitable than other revenues and divesting some of their opportunities, so to speak, that from that baseline, then they're going to move that upwards. That's not how we look at things. We look at basic numbers. In 2022, you did 516. Now you're going to do 500. Your revenues are on a decline. That's plain and simple. So when we look at that same presentation where they talk about their product portfolio overview, this is quite interesting. Here they've plotted their 4 different business segments. You can see on the left here, oncology, data, women's health, and rare diseases. They've plotted them according to size. That's the size of the bubble. The left axis there is non-GAAP gross margin, and then horizontally you can see growth rate. So if something moves to the right, it's growing quickly. If it's below the horizontal line, then it's not very profitable, and the higher it goes, the more profitable it gets. Well, a couple problems here. So their least profitable businesses are their highest growth businesses. Fair enough. Sometimes that's what happens for businesses. And when we look on the right here, we can see with a 24 to 36 month view, they have these 3 components: PGX, somatic, and their patient network. These are their big growth wins that they're expecting to see in the next 2 or 3 years. So we need to wait until March of 2025 for growth to resume. So is Invitae surviving or thriving? Well, a thriving company sees sufficient growth opportunities, strong growth metrics, and they guide to strong revenue numbers. Invitae isn't guiding, they're declining revenues. And look at these 3 key metrics that we extrapolated from recent investor decks. So you have active accounts. These are what they say on the tin, right? Patients served and partners. And we've simply looked at quarter-over-quarter growth as opposed to the actual numbers. Look at the declining trends there. So this is a company that's surviving. They're managing their debt obligations. They're figuring out ways to raise capital, whether that's through more debt or more dilution. And they've all but admitted that. So this article by Stat, quite a political journal, says here, Invitae's new CEO on why the genetic testing firm stopped chasing volume at all costs. And look at this last sentence, pretty much describes the company today. It's now trying to turn things around. So the good news from this latest earnings call is that they were anticipating burning through $600 million for 2022 and exiting last year with $431 million on the books. Well, they did pretty darn well. They actually burnt in 2022 $500 million, and they exited with $450 million. So see, we're now talking about the good news being about the company being able to survive, not thrive, right? So they also fully repaid their $135 million senior secured term loan. We raised this in our last Invitae video as a problem where they had some very restrictive terms on that loan, why we couldn't figure out. They have cash runway now, they say, until the end of 2024, whereas before they were telegraphing having cash runway through 2023 and perhaps beyond. Well, now we're told until the end of 2024. That's great. And they talk here about this $245 million secured debt capacity that could further extend their runway. That's implying then that they're hoping to possibly get to positive operating cash flow by, let's say, 2025. That's a goal that they had listed before that seems to have disappeared from their latest deck. But when we look at the debt profile here, the pro forma you see there, that's what it looks like now. So before, above that, you can see the $350 million there that was due in 2024. That would be next year. The $135 million, very restrictive loan they had. Well, they got rid of all that. They have $14 million left due next year. On the right, you can see that they have the new financing, $305 million, that's due in 2028, convertible around $2.58 a share. If that happens, in other words, if the price of Invitae shares are above $2.58 in 2028 when that debt becomes due, then the lender can take shares instead of cash, in which case that would dilute existing shareholders by about 48%. So that's probably the drop in share price that we saw when earnings were announced. That's a pretty big dump. Well, you would certainly hope their shares are trading above that amount 5 years from now. But when you look at the $1.15 billion in debt, that was from SoftBank back when it was easy to raise capital. And that money's actually convertible from $30 a share and upward. So that would be a very good problem to have. Seems unlikely though, right? So that when it comes to 2028 being 5 years away, it's easy to kind of set that aside, but they'll inevitably have to deal with that. Now, what investors ought to be hoping for is that the company doesn't need to sell more shares or raise more debt for capital to run their operations. And this is a slide that we had looked at, I think, in last year's article, where they had talked about reaching positive operating cash flow by 2025. This goal doesn't appear in their latest deck. Didn't see them talking about that in the slides, but investors should hope that, just based on the good news of this new financing and that comment around having this additional $250-ish million that they can tap into if they need to extend their runway, that perhaps they're still guiding to this positive operating cash flow by 2025. Now, something that was raised by multiple individuals, and it's a good point to make, is this idea of non-GAAP gross margin. So in our previous presentation, in our recent article that was just published, I'll put a link to it in the description of this video. It actually supplements this presentation, so you should probably read that prior to watching this presentation. But we had consistently referred to GAAP gross margins being on the decline. And if you want to calculate those, the same way we do for any of the 460 tech stocks that we cover, we go to the financials filed with the SEC, we look at revenues, and then we look at cost of revenue. So the highlights here where it's highlighting test revenue, it should actually be highlighting total revenue and then the cost of that revenue, cost of goods sold. So when you take those two numbers, you can figure out gross margin. Well, that was 24% in 2021, moving down to 19% in 2022. That's a big problem. That's quite a low gross margin, and just based on their mission statement, this is a company that's selling commodity products that will continue to see pressures on their margins. So how is it that the company can show us on the left-hand side here these beautiful growing gross margin numbers? Well, you'll notice that term non-GAAP. We don't pay attention to non-GAAP ever. We don't get involved with that because non-GAAP is what companies can use to creatively describe their financial metrics, and it starts to get far too detailed for your average retail investor. Retail investors shouldn't have to have a degree in accounting to understand their investments. Now, in this particular case, the point that's being made is this. So here we've taken the numbers so that you can see for yourself. So here's the video or the table that we looked at before that shows total revenue and the cost of revenue, so you can calculate the gross margin. Below that, you can see the reconciliation of their non-GAAP cost of goods sold or cost of revenue, which subtracts amortization. Okay, why is amortization included in COGS? We couldn't figure that out because we've never seen that before. And when you look at what Investopedia has to say about this, it says, typically depreciation and amortization are not included in COGS. However, a portion of depreciation on a production facility might be included in COGS here since it's tied to production. We can't understand why those numbers are being included in there, and it simply makes things quite confusing for investors trying to understand this company. The fact is that the length of time that it will take to amortize those items seems to extend anywhere from 7 to 9 years. So it's likely that we'll continue to see this warped non-GAAP gross margin, or say the actual gross margin, being distorted, and we'll have to look at two different gross margins, which means that probably the best thing to do here is to simply focus on their operating cash flows, the money they're burning through, and the extent of runway that the company claims that they have in front of them. So there's two paths really to take here. One is that you can view this company as having a temporary setback, so a stutter step. If you could think of C3, where they had that change in their business model, although C3 has real gross margins that sit upwards of high 70s, and they're a SaaS business model. It's quite an attractive business, selling software, and could scale quite easily. you could look at it like C3 and say, well, this is a temporary growth setback that will be made up by even more growth down the road. You could say, well, we'll just give it a year to see what 2024 brings, and that'll be the last year they have operations before they need to raise cash. So we could certainly let this simmer and check back in a year. Another path to take is to say, well, they failed to execute. So the reality here is that they were growing their business by paying $1.50 for $1 in revenue growth. The growth story is over because the business wasn't properly managed during good times, especially when SoftBank was raining down cash. And seriously, that's probably the more accurate assessment of these two. Indeed, the company talks about having to reinvent themselves. Now, I wanted to touch a little bit on psychology of this trade. So if you're somebody looking to buy shares now, if you're a risk-averse investor, this probably isn't something that you want to get involved with. We don't give companies second chances. Now, if you were somebody who bought shares when they were cheap, and when I say that, I mean, let's say the last time that we wrote about this firm, they were trading at, $3.60 a share, and you decided to go long then because you thought shares were cheap, and now you're down 50% on your position. Well, you're definitely going to have a different psychology when you're looking at what to do. One thing that's interesting here is just how quote unquote undervalued this firm is. So we use what's called a simple valuation ratio. If this company traded at the same simple valuation ratio of the 190 tech stocks that we calculate this for in our catalog, at a simple valuation ratio of 6, that's the average, it would be trading at about $12 a share. So it would be considered very, very quote-unquote cheap, and there's, of course, a reason for that. Now, if you bought shares back when the tide was high, you'd now be so down on your position, as we are, that the amount is too small to be relevant. And this is a great example of why you should be highly diversified in your portfolio and not try to catch falling knives by overcommitting too much money to a particular position. So when a position is very, very small, there's some temptations that arise. One is, well, I can exit and forget it. It's such a small amount of money that who cares? We'll just move away from it. Or often people say, let's just wait and see what happens. What do I have to lose? I've already lost most of my money in this position anyway. What do I have to lose? The right answer is you should always continue to follow your investing methodology and go by the rules. So there are a couple additional things that we need to consider when we think about our position, and that is holding this stock does not imply that we love or like it. So the way that we classify stocks here at Nanalyze is very simple. If we love a stock, that means we're holding it. If we like a stock, that means we'd consider holding it. And if we wouldn't want to invest in a stock, we're avoiding it. So love, like, and avoid. These are very simple labels that we use here. So when we're holding this stock, we have to say that we're loving it. And that's often misinterpreted by people who say, wow, this isn't a company that you love. So you can ask this question: if we weren't holding this stock, would we consider buying it now? No, we wouldn't. We'd actually put it as an avoid. So that conflict there is problematic. It's not problematic enough where we would consider changing our labels. This is where, being a premium subscriber, as I put my sales hat on, this is where we would communicate these sort of things in webinars and on our Discord server and in our communication with paying subscribers. So take my sales hat off. If we exit this position, we won't look back. So there's also the fact that this has been a very interesting story to cover, and it gets a lot of attention. So if we decide to exit our position, we're not going to take a second look at this firm, and we lose the opportunity to provide information to our readers or subscribers on a firm that generates a lot of attention. So just looking at our own reasons for selling a stock. Remember what I said, always go back to your rules. There's 2 reasons that we sell a disruptive tech stock. The first is because growth has stalled. But how long should growth stall before you sell? Well, how long is a piece of string? Growth in this case has temporarily stalled because of a much needed reorganization. So we can ignore why the reorg was needed in the first place and say, well, maybe we need to give them time to reorganize their business, and now they have a fresh CEO who's going to get the job done. Has our thesis changed? So leaders sell stuff. We invest in leaders. Is Invitae still a leader? Well, does a leader reduce their R&D spend by 50%, which is what has happened over the past 4 quarters? Not necessarily, and we would expect, as we said before, to see that growth to continue. That shows a leader is capturing market share. So is this the old macroeconomic headwinds that everybody else is experiencing? Well, the reality here is that their original genetic testing products failed to offer up the growth that investors had hoped for, and they tried to paint this as a same mission, new path. You can see here on the right, this was taken from the recent investor deck. So they're moving from this broad portfolio to a more integrated, connected portfolio where a single patient and a single test is now one patient, multiple tests. We'd expect to see the dollar value per patient growing up, and it has certainly been trending upwards. Volume focused versus profitable growth. We talked about that, where they're moving away from volume. And this third bit, this innovation sandbox to big bets focus, well, you should, if you don't like the term big bets as risk-averse investors, you should certainly be investing your R&D dollars in the most promising opportunities, but the fact that you're having to significantly cut back on R&D certainly doesn't give us a ton of confidence in that. Now, just to conclude, you know the old saying, right, about boiling a frog. You simply turn up the temperature very slowly, and you have to be careful as an Invitae investor as you start to become accustomed to all the bad news that's coming out. That's why we like to check in with firms once a year. See what we thought then, see what we think now. That helps avoid this problem. People will say, how can you be bearish if you're long? So I was having a conversation with somebody about this firm, and they were surprised at the end of that conversation that we were actually long. If you're long a firm, you ought to be its biggest critic. So we have a couple options here. We can wait another year and check back in, do our annual checkup as we always do. That would be in March, let's say early March 2024, or we can cut bait and exit this position. So we'll have to make that decision, and frankly, it's going to be a rather difficult one to make, and regardless of what we decide to do, that will be communicated to our premium subscribers. So I'm going to put up a video here, the last one we did on Invitae, that you might find of interest. But before you watch that, please click the Nanalyze logo here on the right, subscribe to our channel. Thanks so much for taking the time to watch this today.